Hi, everyone. I'm Rick Bensignor. Today is Tuesday, September 15th, and welcome to this week's In the Know Trader Show. The agenda for today's half hour is we'll talk about candlestick charting as a technical tool, as well as using it in addition to other indicators to greatly up the odds that what a candlestick pattern is telling you might actually work. We'll do our weekly markets overview. And then this week, we will take a look at the biggest consumer discretionary names. We haven't looked at them collectively in quite some time. And even though we've looked at Amazon, for instance, when we look at some of the FANG type names, here we've got about a dozen names or so that are the largest, heaviest weighted names in the XLY, the Consumer Discretionary ETF. And so I figured we'd take a look at those. So let's start off with just candlestick charting. And I'm going to have to assume here that you already know what it is. So I'm not here to teach you candlesticks, that you can find lots of resources to do, but I want to talk more about the efficacy of candlesticks and how much to rely on them. And I will tell you, for me, they tend to be quite a secondary type indicator, almost close to tertiary, meaning like third in line as being important. So I do look at candles, and whether or not I have a chart set up in candle form, where I look at a bar chart that has both the opening and the closing hash marks on either side of the vertical line, I can tell, because in how to read candlesticks, I can tell what the candlestick would be even if I don't have it set to candles. So again, I'm not going to teach candles here, but let's look at some of the very common patterns and whether or not they're really helpful, and how much you can use them in your repertoire, your tool bag of indicators to look at. So here I took obviously a very common stock like Apple, much loved and certainly a terrific long-term performer. Okay, so as I go back in time, what I've done is I've identified some of these common candlestick patterns. Let's take a look at them to see how helpful they may be. So let's see what year we're in here. This is so this is a weekly chart back in 2015, and we'll work our way forward. There is a bearish engulfing pattern here. That is a topping pattern. So after a sideways pattern for quite some time, we have a bearish engulfing. Next week, trades lower. You get your confirmation, and this does sell off, and that was a good signal at the time. This large bullish pattern is a piercing pattern, and that would be a bullish indicator, although the following week had no confirmation of it, so you may or may not have taken the signal at the time. This I'll call a modified evening star, simply because you had 2 weeks in a row somewhat of doji patterns, and that sold off, so possibly good. Here is a bullish engulfing pattern here. So you totally engulfed the prior week, opened beneath it, closed above it, or darn close to it. So let's call that successful. This is a successful bullish pattern. There's an evening star in here. So you might have gotten out with this this bearish signal, although it didn't get confirmation. So if you waited for the next week, you really didn't get confirmation. So you may or may not have sold there. Here is a morning star pattern. In fact, there's an evening star in here, right? Large candle up, doji, big candle down. If you waited for the next week, you got confirmation, but it lasted 1 week and you actually created a morning star in the opposite direction. So not sure if that's helpful or not at the time, because you had a sell signal that immediately went into a buy signal. Here you get a bullish engulfing pattern. This is probably the most, or I'd say the best one of the signals we've seen, because not only did it open beneath the prior week's close and close above the prior week's open, but you also closed above, a few months worth of price action. So that's the cleanest kind of real signal there. You don't really see a pattern here on top that's would have given you an indication in classic candle terms that a top was there. Here, it's not, you don't quite get a piercing pattern bottom because of how it opened relative to the close. Here you have an inverted hammer that could have gotten you to be a seller, and it was only good for a week. And now as we get closer to current price action, let's take a look. There's a bullish engulfing pattern here on the bottom, which was good. Here's an evening star here, which could have easily gotten you out at the wrong time. And now since the high, we don't see much, nor was the candle that made the high anything. So, it's done okay, but in and of itself, and this is probably the most important thing I tell you, is candlesticks are not good enough on their own to be the only technical indicators that you use. And there are people out there who call themselves experts in candles and claim that you can solely use candles to trade with. I will tell you that they're trying to sell you something. You cannot effectively use them as the main indicator that you use. In fact, it's been a long time since it's been done, but years ago, Jack Schwager, the infamous Jack Schwager, who wrote or compiled the book Trading Wizards, which were, I think, the first edition came out in the 1980s, and those were the interviews with the top traders in the world at the time. He also subsequently came out with a technical analysis textbook, and towards the back of it, if I recall, he did some analysis on candle charting and kind of mathematically proved that both over 5 days and 20 days after, this was on daily charts, after you had signals, there was no meaningful information that came from candlestick charts. Now, again, you're going to have those who swear by them and totally disagree. I'd love to see a study that's been done in the last 20 or 30 years, and I haven't seen one that I haven't come across one. But like so many other things, they are just one of many indicators you should use. So, for instance, let's say if we look at the same Apple chart, and I were to put aggressive sequential on, let's see if anything lines up. So here you have upside exhaustion followed by an inverted hammer. Yeah, you might have actually sold in this area, and just because you had both signals, and in this case, neither of them helped you because the market kept going higher. Here we have a sequential sell signal, but you don't really have candle patterns that aligned with it. There was nothing here on the bottom in sequential, but I'll show you in a second what would have given you better evidence to buy this bullish engulfing pattern. And of course, on the all-time highs, you do have an upside exhaustion signal that you don't have in candles. So that, again, if you're a pure candlestick person, this really didn't give you the information you needed at the time. On top of aggressive sequential, let's now put, let's say, Demark's Propulsion in there. So let's go back to this bullish engulfing. Yeah, it was a very good bullish engulfing, except for the fact that the week after opened higher, which is good, you gapped higher, but then you actually closed lower on the week. You had no confirmation of this at the time, making it much more difficult to have been a buyer. Yet, if you knew about Demark's propulsion signal, you would have known that the week that you engulfed, totally, the engulfing week also lined up with a propulsion full exhaustion downside signal, giving you a much better reason to have been a buyer at the time. So here's where combining different signals helps. Let's take a look at, let's put on like a MACD to this too. So look, at the time we got the 13. Would I have necessarily simply taken it in and of itself? I might have. I probably would have. And what would have given me more evidence to have done that is the fact that at the time, the MACD was at the highest level it had been at in years. So we were greatly overbought. In fact, I'm guessing that, yeah, if I put up the cloud chart, if I look at how far price was above its cloud at the same time I had the 13, I know I'm hugely overbought. So that increases the odds that I can play this 13, fade the up move, sell out of some Apple stock and look to buy it back, let's say here, as we get a reason to be a buyer. So this is, you know, Apple's just one example. We can take something much more old, let's call it, well, not old-fashioned, but let's take something like CocaCola, which isn't going to trade like a tech stock. And let's look for some patterns here and see what we see, whether or not any bottoms or tops. So let's see here. You have, well, you have a bearish engulfing, but the next week you bullishly engulf the bearish engulfing. No reason to be a seller on its own from candles, but I do have an upside exhaustion signal here that does help me get some sense of bearishness. So I might have sold in this week here when we break underneath 1, 2, 3, 4 weeks worth of lows. So midweek, you can be a seller, comes back there, but does trade down over time. The 13 here also, this is one I actually probably wouldn't take because I don't like when a 9 count goes straight into a 13 with no breaks along the way. And this looks like, well, there's maybe one bar in here that there was no count from. I'm probably less apt to take this signal, but more, for instance, fade this 9 count. And here you have a hanging man followed by a huge move down. So if you hadn't done selling, it certainly, you'd get some sense in this move that you do need to do some selling in Coke. And this was, of course, the March decline. And this actually took place in February, it looks like. Yeah, so this topped when the market did. And then on the downside, I don't have a Demark indicator down here at the time to have called low. This is, to my knowledge, this bullish candle here is not actually a well-known candle pattern. It's not a bullish engulfing because where it opened. So it didn't make a lower low, and it's not even a piercing one. So to my knowledge, that's not even a bullish signal. And you know, you can do this on any chart and kind of look back and see how many false signals you would have had. How many times in a decline might you have gotten, like here, a bullish engulfing pattern that would have said, okay, potentially be a buyer. Now, you didn't get any confirmation the next week, but some people don't want to wait for confirmation. They want to act on it as soon as they see it. Here's a bullish engulfing pattern, but you would have bought the high. So look, I do look at candles. I do think they add some value, but I don't put a lot of weight on them, and I don't make decisions because a candle pattern showed up. A candle pattern can help corroborate a decision that I'm looking to make, but it's not going to be the reason I make that decision. So unless I see other signals along with a candle, I'm not going to just simply listen to what the candle says and play off of that. I have been using them since Steve Nissen brought them to the Western world. I think it was the early 1990s. And so I've got 30 years of experience with them. And again, I do find some value, but like anything else in technicals, the more different unrelated models that give you the same signal, the better chance that what you're looking at is up to odds of doing what you anticipate that it'll do. So that's this week's kind of trading lesson. Let's go to our markets overview. So we will get, we will do that and do the consumer names. First, let me just give you information on In the Know Trader. Go to inthenowtrader.com to sign up for either a weekly tactical trader report, which concentrates on ETFs only, or a new monthly 7-Eleven sector report, which is designed to outperform the S&P. It's for financial advisors, individual investors, anybody who's looking to outperform the S&P and is willing to put a little work into it as compared to just buying spiders. If you want the average return of the market, buy spiders. If you want to outperform the market, then that's what this monthly newsletter is designed to do by being in no more than 7 of the 11 spider macro ETFs, and with the hope of avoiding the underperformers. And if you stay away from the underperforming sectors, you will outperform the S&P. To contact me, it's rick@notrader.com. So let's take a look at this week versus last week in the S&P. 9 of the 11 sectors moved more than 1% relative to the S&P this week. That doesn't happen that often, that many of them do. There were 3 that underperformed by more than 1%, including technology, so it is still way down there. Nothing's even close to it as far as an underperformer. The next worst one is financials, but this past week, they didn't move very differently than the S&P moved. And you'll see there's also 6 sectors here that picked up at least 1% versus the S&P. So we are seeing a lot of movement and sector rotation going on now, which is kind of healthy in a bull market, but it also could give you some indication that some of the previous leaders are starting to tire. And if you notice that out of the 4 sectors that are outperforming the S&P this year, which is consumer discretionary, commercial services, technology, and materials, 2 of those gave back gains in the past week of over 1% relative to the S&P. So now, for instance, technology is only outperforming the S&P by about 20.5%, well off the highs of the years of this year. And commercial services or communication services has actually fallen back too. All right, let's now take a look at, go back to our charts and let us get to, let's take a quick look at the S&P. Let's look on a weekly basis. And again, we had the, from the whole move off of the bottom, we had the 9 count that has been the high. This is a valid dark cloud cover in candle terms. So we didn't engulf the prior week, but we opened above and then traded more than halfway into it and closed beneath the halfway point. So this is kind of confirmation on market action that you have potential upside exhaustion for the near term. Now, in order to get a bigger breakdown, you've got to get under 32.88, and that's the bearish propulsion momentum level. And unless you break underneath that, the market is just consolidating gains. So if this week, you know, if we close higher on the week this week, should the next week close underneath this, it would be a qualified break. And then if the following Monday confirms it by opening lower and trading underneath next week's low, then you'd have a full qualified and confirmed breakdown. Otherwise, this 9 count is simply giving you a pause in the uptrend, and so far it's doing its job. For more specifics on where to get in on the S&P, that's why you need to go to In the Know Trader and sign up for the weekly tactical trader report. Let's take a look at gold on a weekly basis. So gold has also peaked on a setup 9 count. The actual high was made on the 8th. Now this red line represents what used to be all-time highs in gold, going all the way back to 2011. So you can see that since we've peaked, we continue to hold in and around that same level. And as long as we are still above there, gold is consolidating gains. There's been no real damage. If you get beneath the recent lows from a month ago or so, then you open the door for a move to about 1835. Otherwise, you know, I still think that the case for gold, the fundamentals are bullish, but the market is extended. And the longer we stay in here without breaking down, the better. But realize, you know, when you think about, and if you know this about futures markets, there's plenty of buyers here too, right? There's a buy for every sell. So this whole consolidation in here means there's lots of buyers. And the buyers could either be new longs coming into the market or old shorts who sold at lower levels and shorted the market at lower levels, paying up, taking their losses up here too, to new sellers or new sellers, either old longs getting out or to new shorts. But the more you kind of trade in a range back and forth here, the bigger the next move gets, because eventually news is going to push this higher or lower. And you're going to get all the people who traded in here, half of them are going to be on the wrong side of that subsequent move. And then just in macro sense too, the 10-year, so many people on the street got bullish yields on the break of these trend lines. We have consistently said that unless you get above 7.45 in the TNX, which is the same as 74.5 basis points on the US 10-year, that they have not broken out. And that is why I use the tools I do. I think they're far better than traditional technical analysis. All right, let's now shift to our the consumer discretionary names. So here is, we'll start with the XLY, and then we'll get we'll go through the individual names. So here, to me, very interesting that at the same time we got the weekly 9 count, we also got a combo 13. Combo is a sister model to sequential. It also counts to 13. It just counts differently. So there is an upside exhaustion signal that came in 1 week before the 9 count came in. The last time we had a 13, kept the market sideways for 6 months or so. So that's an effective signal too, because it says that the uptrend is changing trend. And of course, if you go from uptrend to sideways, you have changed trend. So this signal is good. Too early to know yet if this signal is good, but this came at the same time that the S&P hit the targets we were looking for on the upside. So again, right now I'm somewhat defensive. I'm not buying big or anything up here. If I'm buying names, I'm buying names that have been beaten down and have a chance to recover, as compared to paying up on the names that make up this sector. So let's now take a look. Amazon is our first name. All right, so here's the weekly chart on Amazon. Let me add a couple things to this. All right, so we've got a couple, since the March lows were made, you can see that we climbed up the pink line, which is the conversion line from the cloud chart. Last couple of weeks, we've closed beneath it. First signal that something's potentially changing here. If you like the name over time, generally, if you can buy the baseline, which is the secondary support line here. Notice MACD is just crossing now. So if we were to close out the week here, you would actually have mathematically a negative cross. It's not big, it's, they're not spread apart from each other, but you are just seeing the beginnings of a cross here. So given the bearish engulfing pattern that I can see from last week also, we opened above the close, we closed beneath the open. There is some negative stuff here in Amazon. So no reason for me to be paying, to me, $3,100 for the stock. Wait for a pullback. Home Depot. Upside exhaustion signal too. Look, went right to the bearish propulsion level. Didn't break it properly. Didn't close beneath it. It's come right back. This is, it's back above the conversion line. In fact, it closed right on here. So this is certainly stronger than the group. So, first we looked at XLY. Now we're looking at individual names. And so this is an outperformer. You don't have a MACD cross yet. So certainly one of the better names. Do I want to be buying Home Depot here? Probably not, but at least I know that I know where our stop out level is, and that's, we went right to support and turned around from there. So if you break under last week's low, then it has a better chance to pull back. McDonald's. Nine count. A week ago, we've actually gone higher than there, so this looks like we're playing here with, I'm guessing, over all-time highs. So back at 221.83 in August, we're actually just a touch above there. Got to see how this week ends up too. But for now, a good name, and it's not as high also in MACD terms as it's been in the past too. So this may actually be one of the better names. If I'm looking for entry point, it's right around $200 as of right now. Nike. Best name that we're seeing so far. So all-time highs. Not on any count. Let's just add, let's say, I'm going to bring in the most aggressive count I can, which would be aggressive sequential. Nope, so nothing in the way there yet. So from account-wise, we're not exhausted. Look for support in around 110, give or take, both from the conversion line and the what would be a bearish propulsion level, but it all depends on how we get there, whether or not you sell that. Recently, these are usually been buy signals. So they come down, they fail to get actual bearish signals, and they turn around and go back. So first support level right now is, let's say, 108 to 110. Lows. Lows, we're staring at a 13 that went right to bearish propulsion level, held there. Both here again, two different models give me support. And I know it's a high risk buy. So if I happen to have sold it in there, I probably would have come right back in and bought back whatever I'd sold out of. Based on closing price now, this would be the best all-time close. Potential resistance up at 181, but also a really solid name. And you can see the value of having some of these Demark models in here to show us where you go in and find potential support levels, even in the up move, that most other models out there are just simply not going to be able to find and identify. Starbucks. Okay, now this you can see turns on nines. You have 9 bottom here, not all of them, but 9 bottom, 9 high, 9 high, 9 low, and potentially 9 high here. Look at the lagging line versus the cloud. So right around 90-ish, give or take, is where this will either break out from or likely stall. So that's kind of your key level near term. If you've got good profits in it and you've been debating about getting out, I'd use last week's low probably as a stop, and look to, look how it acts near 90. Booking holdings. So has not gotten back to all-time highs, which makes sense for anything that's related to travel and leisure. Bad week last week, trying to recover here. This has been choppy. More important is that this bearish propulsion level closed beneath, but it never properly did with qualified and confirm. I've taught you guys that before. Here's the level now. I don't know, to me, I probably just wouldn't play the name if I don't need to. Target. 8 count made the high, so here's your setup. 9 climbing, it's climbed up the conversion line. So first support right now is around just beneath 138. Nothing really to do in here. Upside target for those long is just shy of 172. And the last one I think we're going to be able to get to this week, let's go to something that's, let's take a look at GM. Just everybody looks at Tesla a heck of a lot, not much at the traditional car makers. So GM, at least getting some price action through the cloud, that's good. We don't have an upside exhaustion signal from a count, but we did hit a propulsion exhaustion level. So here, look for support, top of the cloud, conversion line, first level support, secondary support down here at 25.5. That is it for this week. Hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trade.